Hi there, I'm George Walker, partner and auctioneer at Allsop. Welcome to the first of our summer review podcasts, where we're going to take a look at the commercial property market over the last 6 months from the perspective of the auctioneer's rostrum. I'm joined today by Jo Seth-Smith from OLIM Property. Understands our business very well, having jumped fence and being an auctioneer into a more institutional view on the market, and no doubt she'll have some challenges to add to the data and examples that we'll go through. In the first episode of the 3 podcasts, we'll look back at the last 6 months, we'll look at what Jo's been up to with her fund, and look at what our market statistics are telling us to what buyers have been looking at and how they're looking to invest the money going forward. Jo, you'd like to introduce yourself and where you sit, really.
Thank you, George. So I'm Jo Seth-Smith. I work at OLIM Property, which is an FCA-regulated investment manager of UK commercial property portfolios, to give you the actual hard line, which basically means we have individual discretionary mandates for pension funds, a couple of investment trusts and some Oxford colleges too. And to give you a bit of an idea where we have funds under management currently totaling in excess of about 1.1 billion. And within that, we have about 180 plus properties under management, about 200 odd tenants, and the lot sizes range from about 1 million to 100 million. I would say average lot size is probably around the 6 million mark.
That's really good. So I work in a world which is sort of 500,000 to 10 million, so a subset of the OLIM market. And why people are buying from us is that they are taking a risk on their capital and they're getting an income. Commercial property has always been good at that. It could be a short income on a short lease, a long income on a long lease, and the long income, you'll get less return. That's called the yield. So yield will be lower on a long lease, down to 4.5%. And a short lease is perceived to be quite high risk, and your yield can be into double digits on an annual basis. So, looking at the last 6 months, Jo, I know what we've been doing. What have you been doing in OLIM with as you asset manage away in the portfolio?
Well, it's been a tricky 12 months, to be honest about it. I mean, we've obviously had a very difficult political and economic backdrop to work from or to start from. And we have a number of client mandates, and we are guided by those mandates about what it is we want to be investing our money in, or our clients' money in. I would say for the last 12 months, we've invested in a complete range of sectors, from pubs, supermarkets, industrials, hotels, some government income along the way, and parts of the leisure sector as well. But to be honest with you, we've been focusing not so much on sectors in terms of investment, but more importantly, where we're going to find security of income and longevity of income. So we've been looking for 10 years minimum as an unexpired term, which is essentially up to a break option or the end of a lease. We've been looking at bulletproof covenants, so hence the government income we've been buying, extremely secure companies or corporates. But a lot of it is also down to location as well, because in an uncertain market, it's all very well to rely on covenant, and therefore, covenant, to just go into a bit of detail there, it seems like a very boring property term, and it is in fact a boring property term.
It's got lots of value. So what do you think is a bulletproof covenant?
The
UK government at the moment, fantastic.
I know. Not many would say it, but it's true. I think it's very dependent on what and where you're buying. So, like I was saying, covenant is essentially a way of the funds or the general market weighing up what tenant is a good tenant and will pay its rent, and what tenant is not such a good tenant and won't pay its rent over a period of time. And obviously someone that's got very strong accounts, high turnover, pre-tax profits, net worth, is going to be more attractive than buying somewhere that doesn't in fact have those things. So again, when you were talking about yield and risk, that is where that comes in. But a lot of what's been happening are people are ploughing money into, let's say, a covenant or a tenant, without necessarily considering the underlying property fundamentals. So is it in a cracking location? And a cracking location would be where that tenant is going to trade the best. And do they have any external competitors that are going to come in and take away some of that business going forwards? At the end of the day, you've got to take a step back, I think, a lot of the time, and be able to assess that product independently of the mathematics, if you like.
Sure. I mean, 5 years ago, you wouldn't have considered the Topshop Group Arcadia to be anything other than a bulletproof covenant, and look what's happened, and they're probably one of the biggest on the high street. So the covenant selection, of course, that's where the private investor is happy to take more of a risk, happy to get stuck in, have a 3 or 4 year plan to enhance an asset, and he'll take a risk, or she'll take a risk, and get an enhanced deal for that period.
Yeah, absolutely.
So, which is quite different from your perspective, because you have that mandate for that rock solid income.
Yes, absolutely. And I think actually from a fund point of view versus a private investor point of view, we don't always as funds have the luxury of being able to, spread our wings a little bit further and to take some of those risks. A private investor, however, will focus on probably the things that they know and that they understand, which is why predominantly over the last God knows how many years, retail has taken up a very large part of an auction catalogue, because of course that's what a private investor understands. They know footfall, they know how well a tenant does, because they're up and down that high street all the time.
That's right. And I mean, it's interesting from our survey, you picked up in the last 12 months, the buyers are getting more local. I think 57% of our buyers are now, because we talk to these buyers over every auction, and thank you if you filled the form out, but they do tell us they're more local. And so when there is enhanced risk on increased risk of failures on the high street, as is well documented, those buyers are going to have their local expertise. They're going to know that particular coffee shop does well, that petrol station does well,
yes,
that restaurant does well. It may look a bit big, but they believe it. So that's really interesting. So if we look at specifically, we've had a look at 6 months, and we had a curious year. We started a bit gloomy, and the auctioneer's weapon in marketing is obviously exposure and pricing. I think we started the year thinking things were slightly worse than they were, and we got up to a flying start in the February auction. The February auction actually had the biggest lot we've ever sold under the hammer, £12.5 million in Covent Garden. That appetite continued through March. Obviously, at March, we had the first of the deadlines for Brexit, and things went a bit wrong in May. We finished up very strongly in July, and looking back at that data set, all the yield graphs are saying that actually demand improved substantially. Our customer surveys are saying buyers want a bigger lot size than ever, and they all want to come, and 96% want to come and buy another asset in the market, which is really encouraging for those assets that are sold, and we've done just short of £300 million so far this year, which is great. So if I can be specific, Jo, on some of these sectors, clearly we discussed the fact that high street retail is at risk. Doesn't preclude you from all the retail sectors. Would you be looking at leisure, high street leisure? Would you be looking at supermarkets, C-stores?
Yes,
do you think that?
The answer.
Yeah, that's on the shopping list.
It is on the shopping list, but we've been very lucky. We sold out of a lot of that retail, and that's put us in a very good position. And we were buying and have been buying supermarkets, as you said, leisure, pubs, and that, again, is down to trying to find assets that have these lovely long leases, 20 years plus. They've got indexation, so whether that is retail price index indexation or consumer price indexation, or
just a fixed increase.
Yeah,
like an NCP lease, 2.5% a year.
And I think, to be honest with you, a lot of the problems on the high street is that you aren't getting what you have historically, which is a minimum 10-year lease or a 15-year lease, or whatever it is. It's now very tricky to get anything, probably more than 5 years, and often or not, there is a 3-year break in there.
That's normal. So before we move on specifically, I mean, what does make an alternative? The world as alternatives has been trumpeted for a lot. It used to be, a driving test centre led to the government for 30 years. How wide is alternatives now in your view? What specific things would you refer to as alternative investments?
I think it falls into anything outside the standard sector choice. So car showrooms, car parks, hotels, care homes, caravan parks, solar panels.
Jo, have you got a caravan park?
Of course.
You really
Absolutely.
Where is it?
Who wouldn't, darling? I couldn't possibly say where it is, but they are lovely cash cows, these
Fantastic.
things. Yeah, I know.
Okay. So that's properly alternative.
It is properly alternative, isn't it? Yes. No wind farms yet. Quite upset by that, but maybe one day. But there's, the thing about these alternative sectors is it's where the long leased linked product is available, and we are in a market where there's not a lot of supply right now, and it's the only area to really pick these things up.
Yeah. So, I mean, it's interesting, look at the alternative sectors, and we've been through these car parks with long leases to NCP. They're 18 years, 2.5% per annum. That's per annum every year. And that's going to give the investor a nice return.
Beautiful.
Interesting. I think we had, the most alternative was an energy storage site, which we sold for National Grid, but 40 years. Because if you're going to set up an energy storage facility, huge capital expenditure.
Lovely.
You want the ability to be on there forever. Well, 40 years.
Yeah.
and again, the market was red hot for that. So it's interesting. And our investors are picking up on that.
Yeah.
And they, whilst they like a bit of added value and a bit of yield, if they see these opportunities, they do pay those very strong prices. And I think if we look at the most, as an auctioneer, one of the most telling signs from the last 6 months is actually the most expensive assets we sell are getting more expensive because the shortage, you mentioned, the shortage of this well-let assets, the high street lease is now a 3-year break. Get everything 10 years plus, and people are chasing them harder. So that long-let yield curve, and if you had a look at our review, the bottom line there is actually creeping below 4%, which is, very, very strong. So, in terms of things you'd be wary of, we mentioned high street, but you would be looking, Jo, at long leases regardless, wouldn't you?
We would be, absolutely, yeah. We're in uncertain times, certainty is absolutely everything. I mean, are there areas that we would absolutely not invest in at the moment, or sectors we wouldn't? Possibly, but again, I think it's very dangerous to be too sector specific about what you are and are not going to invest in. It's a dangerous cash flow thing to do, in my opinion. If you can see value there and it fits within the mandate, we'll buy it. But if it doesn't, then we're just simply not going to. But like I said, we're not private investors. We are dealing with other clients' mandates, and we have to buy accordingly.
Have to work with that. And it's an institutional mandate, which is very different to the majority of our investors, as I said. Excellent. And do you believe, just one last point for this section, if you're to believe the Sunday Times, which of course we all do, because I can't start my Sunday without it, Greenridge, New River, back buying, perhaps opportunity knocks. And I think, the where I'd say that some of the clear examples, these big shopping centres that everyone's running from, we sold one at 3 times the reserve price in Bangor, not somewhere you'd choose to invest, but the client wanted out, had a very good reason to sell it, and I think we had 87 people looking at it. So there's the difference between what your requirements are and our market. Our market is full of cash, and if it's great quality, they're happy to take a low yield. If it's high risk, they want a bit of it. So that's quite fun. They've all made some profits. Yeah. And the cash is there to invest. So that concludes the first of these 3 podcasts. Thank you for listening. And Jo, thank you very much for helping me analyse what we've been through. If you would like to find out a little bit more about the market and our review, it's of course available on our website, allsop.co.uk. You can find me on Twitter at AlsopGeorge. And of course my email address at allsopsgeorge.walker@allsop.co.uk. Join us for the next 2 sessions, both available, of course, on our website, where we'll be looking at some specific examples and then be so bold as to venture what might happen for the rest of this year.